To tell us more about all this, we've assembled a Taking Stock think tank. We have Mike Green, Chief Executive, Tenex Capital Management. Tenex helps middle market companies in financial or operational difficulties. Maybe they can add the government to their list. Also, we have Jay Pelosky. He consults on global asset allocations and strategy at J2Z Advisory. And Mark Coffelt. He is the founder and Chief Investment Officer at Empiric Advisors. His Empiric Core Equity Fund has outperformed 98% of its peers year to date. Gentlemen, good to have you with us. Mark Coffelt, let me begin by asking you, is the debate really centered on real numbers? Are we really worried about the debt ceiling, or is there something more at hand?
Well, I think that's really the question. Are the numbers real? You know, we saw Harry Reid do a presentation today. Is it believable? Well, you know, the devil's in the details. We also saw Representative Bonner do a presentation. So I think that's really the $64,000 question is what is in the details?
Jay? The details of any kind of budget deal, any kind of debt ceiling deal, why can't we just separate the two? Is this because the Republicans need the leverage right now in order to at least be able to come back to this topic before the 2012 election?
Well, I think it's a lot of the extend and pretend, Pimm. We've talked about this for so long. Now the market has got it in its mindset that maybe the U.S. is at risk of losing its AAA rating. That's causing a lot of investors to take money off the table. As that liquidity gets reduced, volatility increases. And so that in turn takes more capital off the table. I think at this point, investors are very unsure what the government's going to do. They're taking risk off the table, and that allows us to really start to question what about the risk-free nature of treasuries, which calls into question really how you price all financial instruments. So I think this has become much more than just the details. From an investment perspective, it's become how do we price virtually all the assets which people trade. And that worries people. That takes risk and capital off the table. That increases volatility.
Mike Green, investors taking risk off the table. What about business owners, business leaders? Are they taking risk off the table and just waiting?
Well, yeah, I mean, we heard Jay just speak about people taking capital off the table and waiting. Why are they doing it? Because they think the companies that they want to invest in may be at risk. And when you talk to the business managers and leaders we talk to, they're not hiring and they're putting off production of new products. They're putting off expansion because they're not sure of the trickle-down effect to them, whether it's from tax increases or cuts in spending. They're worried about demand. So one of the reasons people are taking money off the table as investors is because the companies they invest in, which is a proxy for your investment, are slowing down because they're just not sure. Volatility is not good for business people.
All right. Mike Green, it seems as though you and Bernie Marcus, you're probably channeling the same voice. You don't like uncertainty. You want some kind of decision. You think business will be able to deal with whatever comes down from these negotiations. Is there a real deadline in your mind, August 2nd? Does that matter?
Well, I think that it matters to different constituencies. There's a lot of financial constituencies that really do care about it a lot. I think the constituencies I'm referring to, and perhaps Mr. Marcus was as well, were business managers. The longer we wait to make a decision, the longer their period of indecision takes. Decisions about investments they will or will not make. They're just not sure, many people, how the cuts or the increases will impact or trickle down to their businesses. The longer we wait, the longer money and decisions are on the sideline. Money and decisions are on the sideline costs jobs, costs performance for the businesses, and costs investors that are waiting to see how these businesses will perform. So yes, in my view, I'm not sure if the exact date to the business manager is relevant, but the longer we wait, the more we're slowing down the taking the Band-Aid off the sore.
Jay, the idea that the United States could lose its AAA credit rating, that could happen even if the United States doesn't default, right?
Correct. You can raise the debt ceiling, but if the spending cuts and the signs that there's a sustainable path towards fiscal stability is not visible to the rating agencies, then you can have a deal and still have a cut in the U.S. rating, which I think sends real big effects across financial assets.
What would that mean, for example, to pension funds or insurance companies that have specific covenants that say, look, you can hold anything you want in this portfolio as long as it's AAA?
Right, exactly. If that's the case, then you have to sell. And the big question as an investor is, where do you go? Where's that money going to go? And I think one of the places, there are a couple places that seem to me possible candidates to receive some of that money and thus do well out of the crisis. One is investment-grade debt, which you can get a yield of 3–4%, and I think get some capital appreciation if this takes place. And the second is emerging market debt, particularly U.S. U.S. dollar emerging market debt, which is investment grade rated, not affected by the crisis in the developed economies, and could receive significant monies, and currently has a yield of 6 to 7%. So there are some opportunities in what is a pretty risky situation.
Mark Coffelt, do you think the United States will lose its AAA credit rating?
You know, I think there's a good shot that they will, unfortunately. And clearly it has implications for a lot of companies. Maybe not so much for the U.S. government, but clearly for all the financial companies that have to invest in AAA, it makes a big difference. But I think one of the factors that really hasn't been talked about, I think the administration could say that for the time being, that U.S. government debt, even though it may not be rated AAA, should be viewed as AAA. So maybe there's an out.
Jay, an out for the U.S. government. I mean, it sounds like these talks having to do with Europe and, what do they say, a coordinated default or a default in everything but technical name, which doesn't trigger all of those insurance contracts, those credit default swaps. I mean, will there be a massive shift, at least in part of the banks that use treasuries as collateral, just on that basis, short term? Will there have to be a massive shift to cash if indeed the government stops paying on its treasury obligations?
And this is what the investor doesn't know, and this is the uncertainty both in the investment side and in the corporate side. I think what we have is a real spread of what I call sovereign debt infection. And you see it in Europe, where you've spread from the periphery to the core, where we're now talking about core EU countries like Italy and France, and you're seeing it in the U.S., where we're talking about losing the AAA rating. And I think the move towards out of sovereign AAA rated debt into perhaps corporate, high-rated corporate debt in other areas could be a real significant investment effect that would last well beyond August 2nd or whenever the deal gets done. I think this could be the start of a multi-year move away from sovereign more towards the corporate in all its manifestations.
Mike Green, what would you recommend the government do operationally at this point? Punt?
Punt is probably not an option, as we all know here. I think the idea of how the impact of decisions at that level really trickle down to individual business managers is not recognized by as many of our congressional leaders as we would like them
All right, well,
to
maybe
be.
they're listening. Mike Green, we're talking about this idea of what you would suggest to the government to do in order to raise the debt ceiling, because behind this is a real budget debate about spending and about taxes. From the people, the business people that you've talked to, they obviously don't want new taxes, but would they be willing to accept them if indeed there was some kind of new rational voice in Washington?
Well, Pimm, it actually depends on who you speak to. Generally, people don't want taxes raised. You want to be able to do efficient business without the burden of taxing authorities on you. But I think people are realistic about this. You need to have a solution to our deficit spending that gets you closer to narrowing it than making it wider. And if it means a combination of some tax increase with some, cost cutting, people accept it. In fact, if you're a business person, and we mentioned when we were at the break, demand destruction, and you see some large programs that will cut massively in your industry, that will destroy demand, and that could hurt a business person more than a tax increase. So I think people are realistic, no matter which side of the aisle you're on, no matter what your ideology is. I think most people recognize it takes a little bit of both.
Mark Coffelt, come in on the topic of demand destruction right now in the economy. At what point do the increase in prices just make it unbearable for companies to pass along those price hikes?
Well, we haven't reached that point yet. I mean, just today you saw Kimberly-Clark. They missed estimates and they're raising prices. So will they be able to do it? I don't know. But there's been a lot of companies that have progressively raised prices. So at some point, there's going to be pushback. And in some industries, there's pushback. But so far, it's gone through.
Jay, I want to ask you about some opportunities that may seem contrary, given the current state of not only the fiscal problems in Washington and the debt ceiling debate, but also municipal finances. You say there's some opportunities here. Maybe states have gotten the message more clearly than the federal government. Tell us about it.
Well, Pimm, I do think there's an opportunity, and it's coming about through the real economy, which is the rebound in U.S. manufacturing. I believe in the next couple of years we're going to see a renaissance of U.S. manufacturing, both because of import substitution and also because of countries like China setting up plant and production here to be closer to the customer. And so my thesis is that if you look at a basket of manufacturing-heavy states like Ohio or Michigan, Pennsylvania, that have really probably been hurt over the last 15 or 20 years as we've reduced manufacturing, could really benefit from a rebound in manufacturing. And perhaps buying a long-dated basket of those munis from those particular states could offer you a pretty good yield and a pretty good opportunity that will carry on for a period of years. And again, I think there's going to be a lot of money that's going to be looking for long opportunities, in other words, multi-year opportunities where you can get 4, 5, 6, 7% yield and you can keep it and feel reasonably safe. And I think manufacturing state munis could be one of those opportunities.
Mike Green, industrial and manufacturing companies, aren't they, though, addicted to low-cost capital right now?
Well, they are, but at one point I just need to mention about what Jay talked about. It's interesting, one of the leaders for a leading indicator for manufacturers in the U.S. is transportation, and I think many of you noticed that over the last 2 weeks they've all announced general rate increases, which must tell us they're getting orders for transportation for their goods and services in the next few months, so maybe that will be picking up again. But yes, low-cost capital is very important. We're all addicted to it in the U.S. And if that starts going away with increases in interest rates, it's going to make it a little bit harder for people to finance the expansion of their facilities.
Have you had more companies come to you for the kind of specialized help that you offer, helping them dig them out of problems? Because I thought the recession was over.
Oh, no. Well, the recession may be over some, but not for others. If you've had a difficult credit experience, especially during the last recession, the banks that have money now are not willing to lend to people who were troubled borrowers in the last recession. They're giving them a very difficult time, and we need to help those companies restructure their balance sheets so they can become credit quality again. And the president says most of the job creation comes from smaller companies. That's where we need to focus our time right now.
Mark Coffelt, what about increasing interest rates? I was asking Mike Green about the idea that businesses are addicted to low-cost capital. Is that going to continue, or are we going to see increases in interest rates?
You know, I think we're going to see higher interest rates, but I think it's going to be down the road. My best guess is maybe a year away. I don't see them in the near future.
All right, so he doesn't see it in the near future. Is there going to be a time, Jay, when interest rates in the United States increase, and the increase, even though it's going to be nominally small, is going to be on a percentage basis, something that many people have not seen in a long time?
Well, my view on rates, particularly in the Treasuries, Pimm, is that if we get a deal and there's a big spending cut attached to it, that's bullish for bonds, because that is basically going to be reducing inflation risk and growth risk. Bearish, therefore, for equities. Longer term, to get real interest rates rising and change the cycle, we need to see inflation, and that I don't think is coming anytime soon.
All right, I want to thank you very much. More